right, good morning, everybody. It's Friday. Just a second, guys. Realized I was needed to fix something. All right, that's better. So we made it to Friday. At least I think it's Friday. Is it Friday? It is Friday. A little discombobulated this morning. I spent too much time crawling through a bunch of white papers this morning. So I lost track of time. All right, so China eased some restrictions on that COVID zero policy yesterday, which added to a little bit of the boost. Something we've been discussing frequently is that with the SPR releases coming out of the White House, artificially decreasing the cost of fuel at the pumps, it will mess with the metrics on inflation. And so when the SPR releases end and they are no longer artificially decreasing the cost of fuel at the pump, then we're very likely going to see inflation metrics rise again because the cost of fuel raises the cost of everything else, right? So a lower print, one single print showing inflation is abating. The Fed has made it very clear that one data point would not be enough. They want to see a continued trend of lower and lower inflation. And I don't think that they're going to get that anytime soon, right? Over the next quarter, when we continue to get month over month projections, I do not expect that it's going to continue to trend lower, but not able to see that, so just kind of run with what we have. For the moment, it'll be a new leg up. Part of the move yesterday was shorts getting squeezed and adding to the buying. And I had a number of people yesterday ask, or say they were going to try to flip this market over and take it the other direction and got ran over. When we double topped midday, I even tried to take a short and it didn't work, right? Because the metrics were showing that we were slowing down, and cumulative tick, KRE, monsters of tech, the regular tick, the weighted AD, everything was showing that it was all backing off. So when you tried to short, say around 11:30 or so, we'll get into the charts, but it was a good short based on the signals. It was just when those COVID policy restrictions easing up, when that hit the tape, it just brought fuel right in and continued that move to the upside. Not a lot on the table other than a lot of ECB speakers. The president will be speaking tonight, but it'll be way later, so beyond what we need to focus on. The bond market is closed today. That doesn't mean that there won't be any trading in there, just that, you know, like in the overnight hours when our market is closed, there's still trading in the S&P and the NASDAQ. It'll just be a lot lighter than normal. And then we'll be back to normal again on Monday. The rig count at 1 o'clock, I'm not expecting that to have any impact whatsoever on our market. So I wouldn't be concerned with that. Once we're past 10:15 or so, maybe 10:20, we see the results from the consumer sentiment. We ought to be done for the day when it comes to anything economic. No auctions or anything like that. So afternoon 0 days, there's really nothing standing in your way. Like we usually do, start out looking at the volume. This thing is tallying up the volume from the overnight hours starting at around midnight. And we're just looking to see if it's within the boundaries, anywhere between, say, 75 to 80 up to 225 to 250. If we're above that at this time of morning, got to be a little concerned why it's so high. And if we're below that this time of morning, you got to kind of look around and ask, why is it so low? We're within the boundaries. That's all we need to see. So we just turn that thing off because it takes up a lot of space. There's no reason to donate the chart space to that thing. So we are inside day breakout this morning, although not by very much, which it's kind of nice to see that it's not another parabolic morning, right? If it was, I'd be more concerned about what would happen today, right? If you look back at the last CPI day, we had a 6% move. It was really green, really aggressive. And then the very next day, we dumped back down way past 50%, right? So the fact that we had that really big move yesterday and ran it all the way into the close, and then we did not crash and burn in the overnight hours is a really good thing. So not crashing is good, and not going parabolic in the overnight hours is good. We're up slightly, and that's nice to see. We do have a market maker move on the table, more than 0.5%. So we would just add that to the current 21-day ADR, which puts us somewhere in the neighborhood of 3.1/10%. It's about a 125-point move. So we could move that far today, and it would not even be considered an outsized move. Right? It wouldn't be extreme at all. The ADR to the upside, 40.23, and then 40.73. So what you could do at 40.73 is just add on another 26 points. Use the drawing tool. It's not really that complicated. Doesn't have to be perfect. Just kind of eyeball it. You're looking for 0.66. That actually sets us right into 4,100 almost perfectly. So 4,100 is on deck today and would not be out of line at all. And to the downside, we would still be inside of yesterday's range. And it lines up really close with the 618 retrace pullback. But it comes out to, I'm going to call it 38.50, even though that's not spot on perfect. It's pretty close. 38.50. All right, so we've got our extremes on each side. We've got our regular pivot points from yesterday's open, high, low, close, the Globex this morning. What you would really want to focus on at the moment is maintaining inside of this Globex range. And there's a few scenarios as we come into the open that's worth considering. So one of the trades that I like is a little bit of a head fake. It's where we are outside of yesterday's range. So we've had an inside day breakout in the overnight hours, and then we set a high and we pull back from that high, and we hold that pullback as we come into the open. And then at the open, we get that real aggressive pop to the upside, those big candles in the first 5 to 10 minutes. And we hit that as a rejection point. Maybe we overshoot it a little bit, maybe not, but we top out in a rejection on the Globex high and then dump. So that's one thing to be looking for this morning. I don't have anything that says we're going to dump. There's no warning or signal right now that says we should go down or that we're bearish. I'm just talking about the way this setup looks. We've seen it before. When it comes to the indexes, it's like watching reruns on TV. Right? You might not remember exactly the entire plot of the show, but you've seen it before, and you kind of got a feeling for what's on deck because it's something you recognize. That's the indexes. They always do something that they've done before. It's never something new. There's a little bit of a hint in there too, right? Because if you go back and look at day after day after day, you're going to start to see a common theme. Big blowout days like we had yesterday, we've had those before. Sideways days, midday reversals, V bottoms, double tops, every single kind of day that you can have in the indexes has happened before. And on the very rare occasions that something new does happen, everybody talks about it for weeks. So you'll know that it's some new thing, and then it won't be new anymore because now it's happened. The idea behind it is to study what these days look like, get familiar with them, so you can start to identify some of the key characteristics. That's where the 4 trend days came from. Those 4 very specific, very unique trend days. All right, so we talked about rejecting across the Globex. Something else worth considering is that we come into the open and we won't be pulled back from this Globex. We'll actually have run back up to it already and maybe open near the highest point of the Globex. And we would look for that to continue, right? We'd be working on targeting the ADR levels, 4023 and on up. Now, when it comes to a range, you can always measure that range. So Globex high to Globex low, it gives you some pivot points. And if we were to dump down instead of going up, you can still measure that same range, go the other direction, get some pivot points. We're a long ways from the daily pivot. So we've got an MDP, that's a missed daily pivot. If you were to look online, you would find that that is a trade strategy. It's not mine. I didn't develop it. I didn't name it. I have nothing to do with it. I know what it is, and I point it out when I see it. Pivot points are hit by a market usually 80% or more. So when we have a market that has not hit its pivot point for the day, it's called an MDP, and there's a strategy built to go with that. I was looking for my weekly, but I don't see it. Here's the weekly. It's a long ways down. So we are above the weekly significantly. And that doesn't really become too big of an issue yet. But one of the things that we have to talk about is, have we gone too far too fast? Because yesterday was a fairly fast move. We got the 10-day, 30-minute volume profile, and we are outside of the box. When we're outside of the box, we expect to come back into the box. When we're at the top of the box, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. So we're outside the box. We would expect to get back in it. Notice on this 30-minute that it looks like we've got the left shoulder and the head of a Head and Shoulders. So, that's worth considering as well. We have a VPOC from yesterday now. So now we've got a couple of VPOCs underneath us. If we were to break to the downside, we would have to resolve that. 39, it's really close to 39.11. So I would focus more on 39.11 than I would 39.13.5 or whatever this is lining up to be. And we are a lot closer to that one overhead. So we got one at 4004. It's a VPOC from a while back. If we were to break back inside of Friday's level, there's really not a lot of support volume-wise that would slow us down, and should have a free move right back down to the point of control at 38.85 area. But now we got to get into that question of too far and too fast. So I made this indicator, I don't know, a year or two ago, strictly to answer this question. The focus right now, since we're on the 10-day, is how far away from the 10-day are we? And the 10-day acts like the mean, right? So it's, consider it the average, the middle of the basketball court. Play the game of basketball, everything starts in the middle and your destination is on the edges, right? You got to go left or right, up the court, down the court. but everything starts in the middle. So if the 10 period moving average is the middle, and we expand beyond the 10, either to the downside or the upside, how far away from the 10 does this particular market get before that becomes overbought or oversold? Now, I don't like those two words, but they're common enough that when I say them, other people understand them. But they kind of imply that we have had enough and that a market has to kind of stop or turn around. Oh, it's overbought, as if now the buying is going to stop because it's been overbought. That's not necessarily the case. You look at things like stochastics going into an overbought state, or an RSI. That tells you that the strength of the move is at its highest form, that it's solid. Run it until it's no longer running at its highest form. So if you look at something that's overbought and you think, oh, the stochastics went into overbought, so maybe I should short it now, that's a bad idea. Or oversold, as if that somehow implies, since it's oversold, it won't be sold more, and that the selling in some way is going to abate or slow down, and that it might be a good time to buy. And that's not the case. All right. So I don't like to use those phrases simply because they imply that we've reached some kind of plateau or peak and that things need to stop. But every market treats that 10 period moving average differently. Every market has a distance that it gets away from that 10 before it becomes too much. And we see that market pause or turn around and move back to the 10 in a kind of resetting fashion. And that makes sense, right? Because markets don't move in a straight line. They move up in a trend, but they still pull back in that uptrend. Same thing with a downward move. They move down in a trend, but they'll still pull up before continuing to go lower in that trend. So I built this to look back at how far away from the 10 a market gets before it turns around. And then we kind of just average those up. I could have tried to calculate some average where it would count all of these, but that's a lot more code and it's just not worth it. You can visually see for the S&P that when we get past 2% and we start getting into 3%, that's about as far as the market likes to get from that 10 period daily moving average. It has gone beyond 3% a number of times this year, but it doesn't last. It's like little stick figures. It pops up and then it's right back down again. Well, we popped up, right, with that big move beyond 3%, beyond 3.75%, almost into 4%. That was the farthest we've gone from the 10 period moving average to the upside that we've seen this year. So it's time for a pause. It's really just as simple as that, right? It's time for this market to pause and let the 10 get caught up, or it's time for the market to reverse and move back towards the 10. And it does, it's one or the other. And by pause, that doesn't mean we have to stop advancing. You just not advance faster than the moving average is getting moved. So are we overbought? By my metric, yes, we are overbought on the daily. But let's look at the weekly. So for the year, how far away from the 10 period moving average to the upside have we moved? And what's the norm for the year? In that July-August rally, we got above 5%, 5% above the 10-week moving average. And it took a while to get there, right? Like that was a month and a half of sustained active move in that July-August rally. We're not there yet, So that was the peak, but we're certainly past the average. So on the weekly, we are entering into overbought territory, that we're getting into that point where we can say we've moved too far, too fast. So we would be looking for this to calm down a little bit, slow down, to pause, consolidate, back off a little. Yesterday was a very big move, which means you get to measure that candle and plot it out, right? If you caught what I just deleted there a moment ago, I had measured a very big candle here. I don't think that was the one I had measured, but the one that I had measured in the move down, yeah, that was the one. There's the 50% mark. And that's where we had stopped. Right? That's the top of my measurement. That's the bottom of my measurement. Measure from top to bottom. Plot 50% of the move. When we rolled over and made that move to the downside, where did it stop? Right at 50%. We now have a new big candle. Now you don't have to guess or assume which way it's going to go. You can measure that thing in both directions. Doesn't matter. If it moves to the upside, you've got your targets. If it moves to the downside, you've got your targets. The one that I would be focused on, if it does get back inside the candle, is the 50% mark. If we're going to maintain a bullish posture, it should not go below 50% of that big candle. If it does, you really got to call into question, are we still bullish? While we're on the daily chart, this was the range for the week. So 1 standard deviation expected move. That's how far we've gone so far this week within that expected move, or outside of it, I should say. These expected moves are based on volatility. So when the volatility is decreased, the size of the box is decreased. And we can use that to our benefit. We can look at next week's box and ask the question, is there volatility expected for next week that was equal to or greater than the volatility that we had this week? Nope. They've reduced the size of the expected move for next week, indicating or implying that volatility next week is less expected than it was this week, which makes sense because this week we had CPI and next week we've got PPI, but that's about it. We're still in a bear market. If you think about primary trend, secondary trend, tertiary trend, or however you say that word, third stage trend, our primary trend is still in a downtrend. We're still in a bear market. If we get above 4,100, that starts to get called into question. If we get above 43.5 or whatever that August midpoint was, then we're no longer in a downtrend. And we're talking about primary trend, not just, oh, we have trend. So for that, oh, we have trend, a full set of higher highs and higher lows is considered a trend. So 2 higher highs, 2 higher lows, you have a trend. It might be a secondary trend, but it would still be a trend. All right, so we are above the 0 line and we have the green, the cyan above the yellow. So this says on the daily chart that we are in a, that our primary trend is bullish and that our secondary trend is bullish. If you're using the MACD to distinguish your trends. All right, so yesterday I talked about how the market pulled back and gave us a short signal. All the signals were there. The weighted AD had dropped back down below 500. We had ticks pressing down into -8 and into -1,000. We had a green line breakover and a significant retracement away from the group. We had everything that said, take it short. And the short was working until the news came out, and then everything flipped over, right? So just because all the signals are there and the trade doesn't work, it's not because you did something wrong. It's not because your signals lied or that they weren't working. The market changed when new data came out, when news came out. That's it. And that's all it took, right? So it was also the 1 o'clock auction yesterday. I had really anticipated that the 1 o'clock auction would make us dump down like it had the day before. And instead, we rallied up off of it. There was the 1 o'clock auction, right? I mean, just right there, back to the upside. In the SPX, it was at a more critical level. It was right there. No, I don't use a news service other than Finance Juice. All right, that's the only thing I keep track of. There's that, and then there's Trade Flash on Thinkorswim. Trade Flash is run by Hammerstone, and Hammerstone is like a $300 a month alert service. So, you know, you're getting the free version of a crazy expensive news system. You see, it says down at the bottom, market commentary provided by Hammerstone Markets. You can go to Hammerstone Markets and try out their free software download and check their emails out. It's really great content, but it's really expensive stuff once you activate the program. And not for me. The only other thing that I have is that Twitter Discord that I built. And it does a really good job because a lot of the names that I have in that Twitter Discord are fund managers who use the Bloomberg terminal. And the Bloomberg terminal is a $25,000 a year product. So they're using that and they're putting alerts out on Twitter when they see things that they believe are, you know, market moving. Otherwise, the tape alone will tell you that there's changes to the market, right? When the pace and the speed of the orders coming through completely change. I mean, look at that candle. Now I can't turn on volume because it's the SPX, but the options volume picked up significantly right there. And things churned and then turned around drastically. Then when the dollar closed and the bonds closed at 3 o'clock, we had that continuation, that breakout. So when you look at the day and you realize that there are signposts at every point of this chart from yesterday, it was 1 o'clock. We should already have been concerned that the market was going to move to the upside or break down, which is what I had. My trade was the assumption that we were going to break down. So I was wrong. I took a loss there. And I had to make it back up over here. But watching the clock and realizing it was 1 o'clock, not hard to do. Clocks are free. At that point in time, we had every expectation that the market could change because we had economics on deck. At 3 o'clock, same thing. We are always ready for the 3 o'clock change because we know the dollar and the bonds close at 3 o'clock. And that no matter what kind of day you had, it can change completely right there when power hour begins. So neither one of those were a surprise. Don't need a news service for that. Just need to watch the clock. On Tuesday before the close, I asked a question. Are you ready for a 6% move in the S&P? And how will that affect your portfolio? Yesterday, we moved from top to bottom 5.5%. So it wasn't a rhetorical question. It was a serious question. Were you ready for CPI? And now that we've got it and we've got this really big move, how much did that hurt your portfolio? And I've already heard from a number of people who said, oh, I got ran over really bad. That they took a trade on Monday or Tuesday, or that they were carrying trades from last week. Come on, guys. There's no way of knowing which way this market was going to go. All right. It could have been, it could literally have gone in any direction. There's no way to guess or assume. The only thing that you're in control of is being ready for a big move yesterday. So a little tip, if you're not interested in losing money, don't trade in front of a CPI report or an FOMC report or any other report that's expected to be really big. Because if you do that, you're gambling 100%. You might as well go to Vegas. At least they'll give you free drinks in Vegas. It's a pure gamble. You're better off letting the report happen and then take the trade. So now that we've got the report, we've got the big move, we've got gaps to fill. One of the gaps that we want to focus on is the one back in September. I believe that this is the Jackson hole. But let's see. Nope, that's the CPI. All right, so this one's the Jackson hole, 826. So we've got a gap to the upside that needs to be filled. 40.37 is the bottom of that gap. We closed way up here and we opened way down there. Now, when it comes to gaps, that line's in the wrong spot. I like to do my gaps from where we closed to where we opened. Other people do this differently. And I'm not saying that I'm right and they're wrong. I'm just saying I do it differently. Other people, when they're measuring gaps or looking at gaps, they will focus on the candle itself. So where I moved my line from down here, they will consider this, if we reach that point, being a closed gap. So it's worth marking it out, being aware of where the location of that pivot's at, but to me, that's not a closed gap. So right now, the target is 40. I'm going to use round numbers and say 40-40. At 39.70, that's going to be a warning. If we can get through 39.70, then we've got 39.82 and then 40.07, which is really close to the cog line. So we get through 40.11, and then we've got 40.37 and 40.56. We're still waiting on Tier 1 Alpha to come out with their email this morning, but on Tier 1, they're also going to give you gamma levels and volatility bands and the 0 gamma location. You can draw those in too. I just checked the email. We still don't have an email from them yet. Kind of sucks. Their emails don't usually show up before I'm done with my morning briefing. So I almost never get to cover them. We do have a gap below us now that also needs to be covered. We closed way down here and we opened way up here. We also have this because we closed here, we opened here, and we did not close that gap. So if we were to break to the downside, we got some pivots. If we continue this move to the upside, we've got some pivots. I already mentioned it once, but it's worth saying again, mark the 50% location of that big candle from yesterday. 39.09. Notice how the 50% mark lines up with previous structure. That's always a little bit of a tip when you're measuring things out. It should line up with something else. If it doesn't, that might imply there's something wrong. It doesn't have to be, but usually when you're drawing things out and matching up your pivot points, they should form with something that's already there. And that 50% mark ties right in with the pivot point for the breakout. Let's see what we got on the table today. China internet stocks, KWeb is what we're using for that. But those ADR names, so the question is if it goes below the 50% mark, could the acceleration increase to the downside? I mean, it could, but the idea would be, especially for today only, the idea would be that if we drop below 50%, then that uptrend is dead. Right? And that's kind of the whole point. Is this a new trend? And is that uptrend still alive? And have we gone too far before a pullback? If it drops below the 50% mark, that means it also dropped back inside the box, because the 50% mark lined up with the box. So if we drop below 50%, we're back in the box. And that implies that we're back in a range. We're not in a trend. We're not continuing. So how fast it'll go, or is it accelerating or deaccelerating? What if it doesn't cross through until 3:55 in the afternoon? Is it really going to matter that it's accelerating it or not? Right. So I don't know, when it comes to acceleration, rate of change is a really good way to monitor that. I wouldn't anticipate that the rate of change would pick up just because we got below 50%. I would watch to see how we got below 50%. Was it in one swift move with a news report, or did we grind our way down there? Was it today, or did it happen next week? And you're going to want to carry that pivot point forward, just like a VPOC, until we move down and take it out, or until we move far enough away that it's no longer an issue, right? So say we get above this pivot point here. I don't think we would ever need to worry about that 50% point anymore if we got way up there. And just because we go below it 50% doesn't mean we're going to go down. back here, we had this really, really big day. That was the CPI day. The next day, we dumped down, went below the 50% mark, and yet we stabilized, closed for the weekend, came back in, and up we went. We maintained inside this range. So it's a level worth watching. And if you go back and study big candles and what happens after those big candles, you'll kind of get a feel for what should happen and what to watch for. Emerging markets and KWEB both represent China ADR. So PDD or PPD, JD, Baidu, Baba, those are all on the table. Neo, kind of go down the list. All those China names, right? They should be catching a lot of flow. One, because of the China reopening news or the restrictions on their COVID policy. Let's say it that way, right? And then two, just from the continued fuel from yesterday's move. Then we've got the natural gas and energy and oil this morning, also doing really good. And we talked about the idea that it was likely to shake out traders first before doing anything else. And that's exactly what we got. Everybody was so bullish. The call flow in there was just massive. And everybody that I talked to was looking for ways to go long in oil and energy because of the whole election thing. And somebody way smarter than me pointed out it was just so crowded that the market makers, being evil, conniving bastards that they are, would probably crush everybody first, kick the bulls out, and then run it. And that sure is looking like what we've got this morning. Of course, we've also got US dollar Japan below the 142, below 140, really. So we're getting down into a monthly level. 138.95 needs to hold. And we've got the dollar below 108, which is kind of a benchmark. The dollar below 108, this rally has legs. We're looking at, end of year rally. TNX below 38, end of year rally. This also goes right in with the energy and oil, right? The yields down should be a boost to the energy. So these are telling us that the current leg higher is going to start looking like the July-August rally. Unless something comes in and shuts this thing down, then we're going to be looking for the S&P to get up to around 41.5, maybe 42. That should get us in towards the end of the year and the next FOMC meeting, which would be December 14. I don't know why I couldn't remember that. So they have priced in a 50 basis point rate hike for December with an 85% certainty. This is going to be a metric that'll be very easy to keep track of. All you got to do is look at it once a day. We don't want to see this number moving in the other direction unless they're pricing in something smaller like a 25 basis point. All right, so keep your eye on this candle and those percentages. You just want to see them continue to creep a little bit higher. If this starts to go down, then it'll be because we want to see another candle form here, which would be a 25 basis point. We don't want to see this one going back up, which would be a 75 basis point. So the way things stand, I'm still bearish long term. I don't believe that we're done with this bear market, but I do believe that the current rally has legs and we ain't done. With the US dollar Japan below 140 and the Dixie below, call it 108, this has legs that could easily get to 4,100, maybe even more than that. As long as it doesn't go higher than the August high, 4,300, then I'm going to maintain my bear market bias. So any shorts that you're in from, say, the monsters of tech, Apple, Amazon, Microsoft, Google, if you can't defend them, you're very likely going to want to get out of them. And I'm in Microsoft and Apple with puts. So I'll just be selling puts against the puts that I'm holding. That way I don't have to close those puts down. It's not aggressively bullish out there this morning. In the S&P 100, we've got 28 names that are above 0.5%. And they're kind of spread out into a lot of different areas. I can see a lot of monsters of tech in here. We've got Google, Tesla, NVIDIA. So a couple of monsters. And then we've got some just, some great short names. Disney, Nike, those have been, solid shorts this year. Walgreens. Let's push it up a notch to 1%. 16 names in the S&P are up more than 1% this morning. Ford, General Motors, and that's, those two companies have serious issues, right? They can't get chips. They've got cars and trucks just sitting on the lot that they can't sell. They came out at earnings and said, they've got serious problems So the idea that their stock is up, they're just setting up for new shorts. The chip names, the chip sector itself has been great for shorts. NVIDIA and AMD are both connected to Bitcoin sector. So they got a little bit of a beat down just because of their tangent connection there, but also because they're semiconductor names. Still great shorts. So this looks like a lot of short covering, and then the ADR names. So we're not running in a high correlation coefficient this morning. Yesterday we had 99 names in the S&P and we had 100 names in the NASDAQ, all moving in the same direction at the same time. High correlation coefficient. That's not what we're seeing today, at least not distance wise. And it's not really aggressive. 41 names in the NASDAQ. So 41% of the NASDAQ is up 0.5% this morning. DocuSign, Datadog, these are not, big names inspiring confidence, but we got monsters of tech in there. Microsoft, Google. NVIDIA is another monster of tech, but we got a lot of those China names, JD, PDD, Baidu. Those are all a part of the whole China ADR pop. Lots of chip names in there. So oversold rally, short covering rally, shorts getting squeezed. Could start to see a gamma squeeze as well. You can monitor a gamma squeeze by the metrics that it needs to have volume with it, right? If you're looking for a gamma squeeze, it has nothing to do with gamma. They just use that word because, like a naming, like a brand. But a gamma squeeze would have stock sizzle, which is volume, greater than 2, and then a sizzle index greater than 2. And the higher, the better, right? So 3, 4, 5, that would be better. The reason you want to see the volume in that is because if they're squeezing the market makers and forcing them to buy stock, like the Reddit crowd did when they attacked all those shorts, GME and GameStop and all those, when they were attacking them, just buying bucket loads of options, forcing market makers to buy the stock, squeezing the shorts and making that market rip to the upside. Well, one of the key metrics is got to have the stock. So you got to have the volume. %25 of the NASDAQ is up more than 1% this morning. And it's the chip names and the China names. So we want to see good, strong, quality names, not junk. Come on, Thinkorswim. All right, so that's what I'm seeing. That's what I would keep my eye on, are those chip names and the China ADR basket, either through KWeb or EEM. And then watch for any sort of reversal starting to turn back in energy. Otherwise, it should be a fairly straightforward day, just a nice grind to the upside. If all of that starts to reverse and we begin to dump, look for a spike up in the dollar and maybe a reaction out of China and Japan. I wouldn't hold my breath on that though, but we are at a monthly level in Japan, and that, I mean, you kind of hope that that holds. Don't want to see things get out of control. And we are in overbought metrics. So, there is an expectation that we should or could or are likely to just hold the line today and not get anything really more than what we got yesterday. So everybody have a good weekend. Be careful, be safe, and I will see you all next week.